Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the insane amount of financial jargon companies throw at us. And today we are diving into Wells Fargo and company's latest quarterly report, a real beast of a document with a lot packed in there. So what is the big story this quarter? Well, like most big banks, Wells Fargo is navigating a tricky financial landscape with rising interest rates and a slowly changing economy. Let's see how they held up first off. Let's look at the numbers themselves for the quarter ending the 30th of September 2025 Wells. Fargo managed to pull in a total revenue of $21,436 million. That is a nice jump up from the $20,366 million they reported for the same quarter last year, a 5% increase. Which sounds good, but remember inflation and cost of doing business are also up. Now let's talk about their profit applicable to common stock that came in at $5,341 million for the quarter, a solid 10% increase from the $4,852 million last year. That sounds even better, but it's important to see how much came from the core business versus other factors. Looking at the provision for credit losses, which is basically money set aside for potential bad loans, it was $681 million this quarter, down significantly from over $1 billion last year. This could be good news, meaning they think fewer people will default on their loans, or it could mean someone got a bit too optimistic about future economic conditions. Let's dig into the balance sheet a bit. The company's total assets are staggering $2,062,926 million as of the end of September. This is up from $1,922,125 million at the end of last year. So they've grown quite a bit. And what about their deposits? The lifeblood of any bank. Well, total deposits were $1,367,361 million. This is a slight dip from the $1,371,804 million at the end of last year, showing a small but noticeable decrease. Okay, now for the really important stuff, regulatory capital. Wells Fargo's Common Equity Tier 1 ratio under the standardized approach, which is their binding framework, was a healthy 10.99%. This is slightly down from 11.34% last year, but still well above the required regulatory minimum of 9.7%. 0%, this is a crucial number because it shows how much high quality capital they have to absorb. B, unexpected losses. Their risk-weighted assets were $1,242.4 billion. That is a pretty massive number, and it represents the total assets adjusted for their riskiness. So higher risk assets mean more capital needs to be held in reserve. Now for the engine that drives bank profits, net interest income was $11,950 million for the quarter. This is up by $260 million from last year. The net interest margin, which is basically how much profit they make on the difference between lending and borrowing rates, was 2.61%. This is down from 2.74% last year, suggesting that while they are earning more overall, the Pro-Fi TAT margin on each dollar is a bit thinner. On the non-interest income side, things look a bit brighter. It jumped up by $810 million to $9,486 million. Compared to last year, this is a good sign, showing their other businesses like investment banking and card fees are performing well. Investment banking fees alone were up 25%. This department is really carrying some weight here. But expenses are also climbing. Personnel expense went up by $430 million over the year. This is often due to hiring more people, higher salaries, or perhaps severance costs for restructuring. And the tech budget is also up significantly. Technology, telecommunications, and equipment expense increased by 15%, showing they are investing heavily in their systems and digital infrastructure. Let's look at the loans. This is a huge part of any bank's business. Total loans outstanding were $943,102 million. This is up by about $30 billion from the end of last year, driven by growth in commercial loans, especially commercial and industrial loans. It seems they are finding more clients for these types of loans. However, commercial real estate loans are down by 6%. This is definitely an area to watch given the ongoing challenges in that sector, particularly with office properties. Wells Fargo is actively managing this risk though, as seen in their criticized loan figures, which have decreased. For non-accrual loans, which are loans where it is unlikely the borrower will repay the full amount they stood, at $7,614 million, this is actually down slightly from last year, which is a positive sign even with potential economic uncertainties. Their allowance for credit losses, which is the money set aside for potential losses, remains substantial at $14,311 million. In their wealth and investment management segment, total client assets are up 8% to $1,144 billion. This is a strong showing, boosted by higher market valuations and steady inflows. This segment seems to be a real bright spot for Wells Fargo. Scroll text snippets to find and analyze a few key numbers from these tables and translate percentage changes into real-world impacts. Looking at the financial tables, and the numbers that really matter here are the trends. The slight increase in total revenue is good, but the growing expenses, particularly personnel and technology, are eating into those gains. The fact that investment banking fees are up significantly is a strong positive sign and suggests that side of the business is doing quite well though. The slight tightening in net interest margin might indicate some pressure on their core lending business. Regarding capital requirements, their common equity tier 1 ratio at 10.99% under the standardized approach is strong and shows they have a good cushion to absorb losses. This is a critical metric for confidence in the bank's stability. Their available for sale debt securities have an amortized cost of $210 billion, and held to maturity debt securities were $214 billion. Both figures increased, reflecting some cautious investment activity. However, the net unrealized losses on these securities are still substantial and worth keeping an eye on. On the legal front, Wells Fargo is still dealing with a number of lawsuits and investigations. The company 401k plan litigation settlement for $84 million. And the hiring practices lawsuit settlement for $85 million are sizable, but perhaps manageable given the bank's overall size. The interchange litigation is a long-running saga for many banks, and its final resolution is still a bit up in the air. It is clear Wells Fargo faces significant legal and regulatory hurdles, with a maximum exposure to loss of $139 billion from guarantees. However, they believe the worst-case scenarios are unlikely, and their current estimates for probable losses are probably reasonable now. For my take on Wells Fargo, they are a massive entity navigating a complex financial world. Their increase in net income is a positive sign, driven by strong performance in investment banking and wealth management. However, the rising expenses and the slight dip in net interest margin show that core banking operations are facing some pressure. The legal settlements are substantial, but within an expected range for a company of this size. The most important takeaway is their strong Ori capital position, which provides a vital safety net against unexpected economic shocks. The biggest risk remains the commercial real estate sector, particularly office properties, and how that impacts their loan portfolio. And of course, the ongoing legal and regulatory landscape always presents challenges, but their diversification across different business lines offers some resilience. Overall, Wells Fargo appears to be managing well through a mixed economic picture, with some clear strengths in fee generating businesses, but they must continue to tightly control expenses and carefully manage credit risk, especially in commercial real estate. What do you think about Wells Fargo's performance and outlook? Drop your thoughts in the comments below. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into corporate filings, and don't forget to check out our Discord community linked in the description for more in-depth discussions and to connect with other finance enthusiasts. Thanks for watching. See you next time.